people that do not understand how overrides and property taxes work. The intent of tonight is to explain how property taxes are calculated, to discuss the types of Proposition 2.5 overrides, to illustrate the estimated impact of the July 17th override, and to show the types of property tax relief that are available to taxpayers should they have a financial hardship in paying their taxes. So what this presentation is not tonight, it's not a forum for a pro or anti-override presentation. It's not a debate on whether or not the override is needed or not needed. It does not speculate on what may or may not happen if the override vote fails. And the questions will be limited to the contents of the slide. So we don't want to get off track because the selectmen have graciously allowed us a certain amount of time tonight, and they do have other business to conduct. So what are property taxes? And here's the technical definition of what property taxes are, which they are a tax collected on real estate and other personal property, calculated by a local government, paid for by the owner of the property. The tax is usually based on the assessed value of the owned property, including the land. The local governing body, which in our case would be town meeting, will use the taxes to fund various government services and other items deemed necessary. So in Rehoboth, property taxes are our principal source of income to run the town. We pay in property tax about 75% of the town's total generated revenue come from property taxes. So the other 26% come from different sources like local receipts, state aid, motor vehicle excise taxes, and some other miscellaneous revenue sources. So as you can see, property taxes are really the bulk of the money that we get to run the town. So in order to understand how your property tax bill is computed, you kind of need to know some technical definitions because there are different components that come into play. And a lot of people get confused as they look at their bill and they don't really know, well, how is my tax bill computed? And I hope after we go through these that you'll all have an understanding of how exactly it is when you get your tax bill from the town as how it was calculated. So you need to know what the definition of the tax levy is, what the EQV, which is the equalized valuation or the tax base is, what the tax rate is, and what your assessed value is. So the tax levy is the amount of money that we can raise through real estate and personal property taxes. Each year, the assessors determine what that amount is in accordance with the law pertaining to Proposition 2.5. The amount the tax levy can be in any given year is referred to as the tax levy limit, sometimes just abbreviated as the levy limit. If the town does not tax to the maximum amount of the levy limit for that year, the difference between what they can tax to and what they do tax to is referred to as excess levy capacity. The levy limit should not be confused with what is known as the levy ceiling. And we'll talk about the levy ceiling in a couple of slides. Rehoboth's annual tax levy is usually around 100% of the levy limit. We do not have any significant excess levy capacity. We're talking maybe $1,000 or $2,000, sometimes as much as $10,000. And that's because how the tax levy, the tax rate, all these things are computed actually doesn't occur until the fall, when the assessors go through and they fill out what's called a tax recapitulation sheet. And so what we deal with when we go through budget season, like we just went through in May, we deal with estimates. So sometimes there's a little bit of a difference between what the assessors sort of estimate and what we end up with in the fall, and that would be the excess levy capacity. So in fiscal year 19, which just started in July 1st, our property tax levy, which excludes the debt exclusion and capital exclusions, is estimated to be just shy of $21.5 million, $21,427,000. So that's what the tax levy is. That's how much we can raise in terms of property tax. Another piece to the puzzle is called the equalized valuation. And the equalized valuation is a determination of the full and fair cash value of all property in town as of a certain taxable date. In other words, it's the value of all the property in town added together. This is also sometimes referred to as the tax base. So in fiscal year 19, our tax base, our EQV, is estimated to be $1.863 billion. That's a value of all the property in town added together. That represents a modest 1.2% increase over fiscal year 18's $1.822 billion. So here we have an imaginary town called Rehoboth, which if many of you have ever excavated in northern Rehoboth, you're very familiar with. So in Rehoboth here, we have just 8 pieces of property. And each piece of property has a value, and when they're all added together, you get $3.2 million. So that's the EQV of all the property that's added together in town. So what is the tax rate? This is another thing that you often hear people talk a great deal about. Again, the technical definition of the tax rate is it's the amount of property tax stated in terms of a unit of the municipal tax base. For example, $11.97 per $1,000 of assessed value. A community calculates its tax rate annually by filling out that tax recapitulation sheet, which is provided as an Excel spreadsheet by the Department of Revenue. Now, some communities have what's called a split tax rate, where there are separate rates for commercial and separate rates for residential. And what that allows communities to do is it allows to shift some of the burden from the residential taxpayer to the commercial taxpayer. That works out very well in communities that have a significant commercial tax base. Seekonk, for example, or South Attleboro, or Foxborough. Unfortunately, in Rehoboth, 92% of our tax levy comes from residential properties. So we do not have a significant amount of commercial property in Rehoboth. And there are many different reasons for that. Roughly 8% of the property in town is commercial, industrial, and so forth. And many of those are, much of that 8% are also family-owned farms. So even if we were to look at potentially having a split tax rate to shift some of the burden onto commercial enterprises, we really wouldn't get a lot of money. Well, let me rephrase that. We wouldn't see a tremendous shift. All it does is redistribute the tax levy between the residential and the commercial. It doesn't generate more money. So in the case of that, the tax levy of being $21.4 million, even if we had a split tax rate, we can still only collect $21.4 million. It's just how it gets split in between commercial and residential. And because we have 8% commercial in town, we're not going to, you wouldn't really be able to shift all that much onto the commercial property and save the residential taxpayers a significant amount of money. So for the purposes of our presentation tonight, we're just going to simplify the explanation speak in terms of round numbers, because fiscal year 19 will not be done until the tax recap sheet will not be done until sometime in the fall. So the fiscal year 18 tax rate, which is the fiscal year that just ended June 30, that tax rate is computed by taking the tax levy of the town divided by the EQV. That's all the tax rate is. So if you take that 21, this was the tax levy with the debt exclusions and capital assessments built into it in fiscal year 18. And then if we take the EQV for fiscal year 18, you divide the 21 million by the 1.8 billion, you end up with a tax rate of $11.97 per thousand. So that's all the tax rate is. It's the tax levy of the town divided by the EQV. So there are some fallacies that have been discussed about the tax rate. One fallacy that you often hear is that we have a low tax rate in Rehoboth. Well, a community's tax rate decreases, not taking into account when debt exclusions fall off the tax bill. When the relative rate of the property, which is being added to the tax base, the EQV, is increasing at a higher rate than what the tax levy is. So if the tax levy is only going up by 2.5% per year, but the tax base is going up by 3.5% per year, your divide, your math, okay, is going to grow at a larger rate than the dividend. So you end up with a tax rate that goes down because you're taking a larger number, dividing it into a smaller number. So year over year, if the EQV increases at a faster rate than what the tax levy does, then you'll see a continued drop in the tax rate, excluding when things like the senior center or the bonds that we have for the various school projects come off the tax rate. So it's entirely possible that we could pass this override, which would raise our tax levy, but still our tax rate would go down because of a larger increase in the tax base. Now, this isn't very probable. However, it is a possibility because we are entering a revaluation cycle right now. And during a revaluation cycle, what happens is the assessors go out and they go through all the property in town and they take a look at it and they say, is this property assessed correctly? We'll talk about assessments in a minute. So it's possible, although not very probable, that even when the override passes in July, that your tax rate could still end up going down. Okay? The actual metric to focus on is not the tax rate, but the town's tax levy, which is how much money we bring in each year in order to pay the bills of the town. So now that we know about what the tax levy is and what the tax rate is, and what the tax base or the EQV is, how exactly does your property tax how does your tax bill get computed? So the missing piece of the puzzle is your assessment. And your assessed value is the dollar value assigned to your property, which measures your share of the applicable taxes. So the assessed valuation determines the value of the property for tax purposes and takes into account things like comparable sales and inspections by the assessors. And the sum of everybody's assessment is that tax base, or the EQV of the tax. So your tax bill follows a very simple mathematical formula. It is simply what your assessed value is divided by 1,000, multiplied by that tax rate per $1,000. So in fiscal year 18, according to the Department of Local Services, the average single-family house in Rehoboth has an assessed value of $385,000. And our tax rate is $11.97 per 1,000. So our tax bill for that person that happens to own that average single-family house, their tax bill is that $384,550 divided by 1,000, multiplied by $11.97, or $4,603 rounded up. And that's their tax bill for the year. So that's how your tax bill is computed. Now, one of the things that you're going to hear about in terms of the override is we're overriding Proposition 2.5. What is Proposition 2.5? Well, Proposition 2.5 is a law which was implemented in 1982, and it limits the annual property tax levy increase to 2.5%. It also sets the maximum property tax levy that the town can have at 2.5% of the EQV. So that number, that 2.5% of the EQV, is known as the levy ceiling. That's the maximum amount of money that you could be taxed for your property tax. So a very common misconception with Proposition 2.5 is it means my tax bill is only going to go up 2.5% per year, and that's not true. Your taxes can go up by more than 2.5% per year for a variety of different reasons. Okay, Proposition 2.5 applies to the tax levy as a whole. It doesn't apply to individual tax bills. So you have to remember that the key metric is what your assessed value is. So if your assessed value goes up or goes down, or even stays the same in relation to everyone else's, then your property taxes can go up and down. Because let's say, for example, that you don't do anything to your house, but your neighbors do a lot of work and fix up their houses. Well, now their houses are worth more money, but your house is still valued about the same. So the tax levy can only go up 2.5%. But now their share of that 2.5 increase is going to be more than what yours would be, because their house is now worth more money than yours is. And conversely, if your property value falls. So I'm not suggesting to people that you don't paint your house and not mow your grass to let your property values go down. Because if everybody did that, you'd still end up paying the same, because the town raises that $21.4 million regardless. It's just how it gets distributed. It gets distributed according to your assessed value and that relationship to everybody else. So if we go back to Rockhovet here. So here's a real simple example. And I did it so that the math was nice and easy. So in Rockhovet, we only have 8 people that live there. And the same developer built all the houses, as you can see. But the trim levels inside are a little bit different. So somebody might have granite here and marble over here, but they might just have slate over here. So if the tax levy is for Rockhovet is $60,000 and the EQV is 3.2 million, then the tax rate in Rockhovet is $18.75 per $1,000. So for these people that live in Rockhovet, this guy over here, or woman who owns this house at $400,000, is going to pay $7,500 in property tax. 400,000 divided by 1,000 multiplied by 18.75 gives you $7,500. And when you add up all the values, this guy here lets his house go at 175. And now then we have some real nice properties down on Cameron Way here at 625. So if you add up all the value of the tax, you get the tax levy of the town. So what happens next year? Well, what might happen next year is we might go through a lot of new growth in town. We might have passed an override. We had some changes to the tax levy such that the tax levy actually goes up 8.3% to $65,000. But because we went through a revaluation and we had some new growth, which would be, for instance, somebody adding a garage onto their house, we saw the EQV go up 9.375%. So the EQV, the tax base, went up higher at a greater rate than the tax levy. So what ends up happening is the tax rate drops to 18.57 per thousand. And the assessors went out and they revisit everybody's house. So this person here that had that $400,000 house, well, they didn't take care of it. Their property value went down to $390,000. And this person here on Cameron Way, they did a lot of work on their house. They're up to $725,000. So the assessors went on, they revalued all the property. And there's not a lot of property in Rockhovet, so it didn't take them that long. So what does that mean? Well, it means that this person's tax went to $7,200, and this person's went to $13,464, which, when you look at the percentage increases or decreases, this person's, even though the tax levy went up 8.3%, this person's tax bill went down 3.42%. And even though the tax levy went up 8.3%, this person's bill went up 27% because they did a lot of work on their house. So that's why your assessment is really the important number to pay attention to, because your assessment is your percentage of the whole of the tax levy of the town. And so it's going to represent how much you're going to pay. So if your value goes up or goes down disproportionately according to all your other fellow residents in town, you can either see a huge increase in your tax bill, or you can see a decrease in your tax bill. So with Proposition 2.5, we can raise the tax levy by more than 2.5% annually. And there are three ways for us to do that. The first is a debt exclusion, and we just passed one of these for the work at the high school. That is a temporary increase in taxes for more than 1 year. We have what are called capital outlay exclusions. Those are also temporary, and they're for 1 year, usually. And then we have an override, which is a permanent increase in the levy limit of the town. Debt exclusions and capital outlay exclusions are temporary because they are passed for a certain term, such as 20 years and 1 year. And after that term expires, they come off. Now, some would argue that, depending upon your age, a 20-year debt exclusion is a permanent increase. But for all practical purposes, really, debt exclusions and capital outlay exclusions are considered temporary increases, even though they could be multiple. The debt exclusion would be 20 years. So, under Proposition 2.5, again, the levy ceiling, the tax levy can never be increased above 2.5% of the town's EQV. In fiscal year 18, the tax levy ceiling for Rehoboth was $45.6 million, because 2.5% of that $1.82 billion is $45.6 million. That would be the maximum amount of property tax that we could levy to homeowners in Rehoboth. The difference between what our levy limit is, what we currently tax people at, and what the levy ceiling is referred to as the town's override capacity. And our override capacity in Rehoboth is around $24 million. So that means that we could have an override. We could theoretically have an override for $24 million. So, if the town's tax levy, and just a couple other points, if the town's tax levy was equal to its levy ceiling, because we have one tax rate in Rehoboth, we don't have a split tax rate, the residential tax rate would be $25 per thousand, which means that that average single-family home that we talked about, according to the Department of Local Services, the property tax on that house would be $9,600 on that house. Be about double, about what it, a little more than double what it is today. So the annual tax levy increase, if we were at our levy ceiling of the $45 million, would be $1.14 million, which is 2.5% of that 45.6 million. That, even that number, that $1.14 million number, that's far less than the $1.9 million overall increase between the school and the town budgets this past year. So even if we were at the levy ceiling, we'd still be short. So we also have debt exclusions. What are debt exclusions? Let's talk a little bit about each type of override. Again, the debt exclusion increases the amount of property tax that we can raise for a period of time for a capital project, such as 20 years. And once that capital project is paid off, whatever that amount is, that's added to your tax bill comes off. Because these projects are multi-year and the amount is spread out over, for example, 20 years, the effect on your tax bill can be really small. So debt exclusions can look like really small numbers year over year. And the other thing about debt exclusions is that they're not used in the calculation of the 2.5% levy limit increase. So that's why sometimes you'll see a couple of different, you'll see multiple numbers for fiscal year 18, one with debt exclusions, one without debt exclusions in some of the slides. That's because the 2.5 levy limit increase is calculated on the tax levy without the debt exclusions added into it. So, for example, in 2018, we passed the debt exclusion for $1.95 million to replace the roof of the high school. The expected term of the bond is 20 years. So the tax impact, when you look at your tax bill, 1.95 million divided by 20 years is only $97,500 per year plus 3% interest. Or say, again, to use round numbers, around $10,000, $100,000 annually. So that adds to the tax levy $100,000, which is then spread out among all the taxpayers enrolled. So it actually comes out to be a really small number, year over year. So our tax levy in fiscal year 18 was about 21 million. So 100K is approximately 1/2 of 1% of the tax levy. So the annual impact for a typical single-family house would be about $23. You take 1/2 of 1% of 21 million, 1/2, you get 1/2 of 1% of that typical family bill of 4603, comes out to be about $23. And then at the end of 20 years, that $23 falls off the tax bill. Capital outlay exclusions. Capital outlay exclusions are similar to debt exclusions, but they're for 1 year, and then they come off. So the current debt exclusions and capital outlay exclusions that you have on your tax bill today include debt exclusion for the high school, the debt exclusion that we just passed for the roof replacement, which will take effect in this year, Beckwith Middle School roof replacement, the Palmer River roof replacement, the Beckwith and Palmer River window replacement projects. And then in fiscal year 18, we also had money that was allocated as a capital exclusion for the school district's fiber optic network. That comes off your tax bill in fiscal year 19 because it was a capital exclusion. So that brings us to the last type of override, which is a permanent increase in the tax levy. And this is sometimes referred to as an operational override because generally it's used for operating expenses. And once approved, the override amount becomes a permanent part of the levy limit. So the new increased levy limit then increases by 2.5% per year. It does not mean once you override 2.5 that next year the selectmen could turn around and say, we're going to increase taxes 6%. It's this year adds a certain amount to the tax levy, and then next year, 2.5% of that new larger number. So, for example, without the override, our levy limit without the debt exclusions this year is 21.4 million. Our expected increase for Proposition 2.5 is $535,000. That means our estimated levy in fiscal year 18, fiscal year 20, next year, without the override, would be around 21.9 million. And our Proposition 2.5 levy increase on that would be 549,000, roughly. There are a lot of different numbers that come into play. So that number would actually probably be a little bit more. It might be closer to 560,000, for instance. But you can see the math. Basically, what you're doing is you take this current fiscal year levy limit, the increase to get the new tax levy for year 20, which you then add another 2.5% into, and so on and so forth. If we added in the $2.5 million override, right, the property tax levy for fiscal year 19 goes up to $23.4 million. The levy increase, because the levy increase is based upon last year's levy, it's still $535,000. But when you add those two numbers together, the estimated tax levy in fiscal year 20 would be a little over 24 million, which if you then take a 2.5% increase on that 24 million, you get about $601,000. So you can see where we get the one-time injection of the $2.1 million, and then we get about an additional $50,000 more or less, which if you think about it makes sense, because 2.5% of $2.1 million is around $50,000. So the override passes this year, we get the one-time injection of the $2.1 million, and then we get an additional, roughly an additional $50,000 each year after that, then compounded annually for a 2.5 increase. Okay, in Rehoboth, we've never passed an operational override. The last time we attempted was 2015, and that failed by 303 votes. So on July 17th, you're going to be asked to approve an operational override in the amount of $2.1 million to fund an above net minimum appropriation of $3,286,000 for the regional school system, for a total appropriation of $17.95 million. The estimated tax levy in fiscal year 19 is, again, without the debt exclusions, is $21.4 million. So that override request of $2.1 million represents a 9.875 increase in the estimated levy. 2.1 divided by that big number comes up with the percentage. Okay. Now, due to how our tax bills are computed, and you've seen that we have all these kind of moving parts here that don't really come together until the fall, all we can really do is give you an estimate and come up with a rough approximation, because the levy limit might vary a little bit, the EQV is going to vary a little bit, your assessment might change between this year and last year. So the numbers that you see here are really kind of rough approximations. So you should keep that in mind. So all we can really do is kind of give you an estimate. And it's important that you have to remember that the actual number could be higher or lower. So what is the estimated impact on that typical single-family home? Well, if you look at your fiscal year 18 property tax bill of $4,603, the capital exclusion for the fiber optic project at the DR regional school system drops off, and that was about $20. Your annual Proposition 2.5 increase, which is 2.5% of that number, is about $115. That goes on to the bill. And then we have the roof bond that we just passed for the high school roof. That adds about $23. So the pre-override subtotal, even not taking into account what the override would be about a $4,700 tax bill, which is about a 2.5% increase, because about roughly 0.5% falls off of the capital exclusion, 0.5% comes on for the roof bond. So those sort of cancel one another out, and then all you really see is that 2.5 increase. So the pre-override subtotal, if the override didn't pass, you're looking at around a $4,700 tax bill. The override would be 9.875% of this number, which is $453, or 9.875%. So the total estimated fiscal year 19 tax bill would be $5,174, which represents a 12.375% increase over last year's tax bill. So you can go home and you can kind of do the math. If you take a look at you should have just gotten a tax bill in the mail. And that's based upon last year's tax bill. And you can take a look at that and you can say, okay, well, if it's $5,000, add roughly 12.3% to it, and that's about what I would expect to pay this year. Okay. Preliminary tax bills just went out. You should have them by now. They're based upon fiscal year 18 tax bill. It does not contain the override, nor does it contain the school bond, nor does it contain the capital exclusion dropping off. It is simply last year's tax bill divided by 4 for 4 quarters. The actual tax bills, which get mailed out in usually late December, early January, for payment in February and May, and that's what the actual amount would be, and would contain the amount of the override. It's important to remember that, because the override impact will only appear on your last 2 tax bills, rather than spread out over all 4. So for example, the average single-family homeowner is going to receive a preliminary tax bill for $1,100 due in August and November. That $4,600 divided by 2. So they're going to see a quarterly tax bill of $1,105. But when the override passes, their new tax bill would be $5,174. So February and May's tax bills would actually be $1,436, not the $1,100, because the new amount of $5,174 less what they've already paid in the preliminary leaves a balance of $2,972, which divided by 2 is $1,436. So it's important to remember that, because if you have a mortgage and you have an escrow account with your mortgage company, you may want to start putting some extra money into your escrow account so you're not short. Okay, so that's the impact. What happens if you can't afford it, or you have a hardship? Well, there are different types of property tax relief that's available to homeowners. There are abatements, exemptions, and work-off programs. An abatement is a reduction in the amount of a committed tax. It's a remedy for a taxpayer when you think your assessed value is overvalued. So you think your property has been valued by the assessors at too much money. Or you think that you're disproportionately assessed compared to everybody else. Or you think that your property is classified wrong, because there are different classifications. So if you think your property is this really isn't applicable in Rehoboth per se, because we have one tax rate. But if you were at Seekonk and you had a split tax rate, well, if you're being taxed as a commercial property and you put on a residence, you're going to file an abatement and say, hey, my property is a residence, you're taxing me as a commercial property. Okay. So for an abatement, you have to file an application with the assessors requesting the abatement. They have 3 months from the date they receive it to grant or deny it, and it has to be filed based upon the value of the actual tax bill, not the preliminary tax bill. An exemption discharges a taxpayer from the legal obligation to pay all or part of the tax. So that's different from an abatement. An abatement changes the amount of tax that you're being asked to pay. An exemption doesn't change the amount of tax that you're being asked to pay, but what it's doing is it's sort of, in a sense, giving you a rebate or forgiving some of that tax. And there are exemptions out there for seniors over 70, folks that are blind, surviving spouses, and veterans. The senior 70 and older exemption is based upon the income and assets. It's not automatic, and you have to file for it each year because it's based upon income and assets. The blind, you have to be legally blind with a certificate of blindness from the commission. A veteran, you have to have at least a 10% service-connected disability with a certificate from the Department of Veterans Affairs or a branch of the service. And there's also what's called the Community Preservation Act exemption, and that's a 1% exemption that's based upon the total family income. So there are these different exemptions that you can apply for in order to get your tax reduced. Not every exemption has been adopted by the town. So if you read about an exemption online, that doesn't necessarily mean that we have it. Check with the assessor's office. The qualification terms and conditions vary for each type of exemption. Check with the assessor's office. You see the trend here. Okay? Taxpayers usually have to file an application for each fiscal year, and they're due on different dates. Check with the assessor's office. And usually you only qualify for one type of exemption. If you qualify for multiple, and you receive one of the highest values, again, check with the assessor's office. The ladies in the assessor's office, Mandy and Linda, they do a wonderful job. They're there to help you. They're happy to answer your questions. They're incredibly knowledgeable, and they're very, very helpful. I can't speak enough about that. We also have work-off programs. We have a senior citizen property tax work-off abatement program. There's a lot of words in there. And then we have the VALOR Act too. So the senior citizen property tax work-off abatement program, that's administered here by the COA. The program allows for property owners or spouses over the age of 65 to volunteer services for the town at minimum wage. This is a little bit out of date because I think they just increased the minimum wage. So you can get a reduction of up to $500, and it's based upon you work for whatever the hours are at minimum wage. So you're asked to do different various tasks for the town. The value of the work, this is very important. The value of the work is not subject to state taxes, but is subject to federal withholding, and it's credited against your property tax obligations. So if you have more questions about the senior work-off program, contact Lynn here at the COA, and she can provide you more information about it. And that brings us to the VALOR Act, and this is very similar to the senior program, except it's for veterans. Again, they can work for X number of hours at whatever the current minimum wage is, up to $500. And the best thing I can say here is, if you're a vet, contact the veterans agent, Jake Kramer, again, another dedicated town employee that's very helpful. He'll go out of his way to help you and give you information. He can tell you everything that you need to know about the VALOR Act and what you know. If you have questions, about the town budget, you can email or call me. If you have questions about the school budget, contact Dr. Azar. If you have questions about the vote override process, contact the town clerk, Laura Schwab. If you have questions about your property assessment, your tax bill, exemptions and abatements, contact the assessor's office. If you have questions about paying the tax bill, contact Cheryl Bouvet, the town collector. If you have questions about the senior work-off program, contact Lynn Sherman. And the VALOR Act, our veterans agent, Jake Kramer. And if you have a question and you don't know who to go for the answer, Helen is another dedicated town employee, and if she doesn't know the answer, she knows who knows the answer, and she will get the person in touch with you. Don't go on social media. Don't read social media looking for information, because I will say it again, it is a cesspool of ignorance. So, further reading. This, by the way, this presentation, town clerk graciously made it available on the town webpage, so you can download it there. There is some further reading that you can do if you find this stuff really fascinating. Us finance guys. Some of you out in the back, I see it dozing off. And I'd just like to thank the people that helped put this presentation together. Doug, Martin, both on the Finance Committee, George Solis on the School Committee and Finance Committee, Sue McBride, another member of the Finance Committee, Lena, the COA Director, and Jerry here helped quite a bit, giving me his feedback, and of course Jake Kramer. So that pretty much concludes the talk. I threw a lot of information out at you to get through this. Do you have any questions? You had your hand raised at one point.
I did, but now I just want to say what an awesome presentation that was.
Oh, thank you. You're going to give me a big head. I don't already have a big enough.
That was about the best presentation I've ever seen.
So hopefully, are there any other questions? Again, we don't really want to get into a lot of what ifs and what have you, but I think the selectmen are willing to entertain questions, but we, don't want this to turn into kind of a free-for-all. Yes, ma'am?
This is the tax bill that I get,
Yes.
right? Is it divided into general fund and school fund?
No.
No, it's all one.
You see $1 amount quarter.
Now, was that changed in the beginning? Did we have way back? Did we have a general fund amount and the other amount for school?
You may have years ago. I'm only 53, so
I'm only 52.
you're a lot younger than I am. So I don't remember. I've only been paying property taxes for about 33 years, and not all that time in Rehoboth. So
The answer is, it has never, in my 40-something years in government here, it's never been split. That's something you do in New York and some other states, but not in Massachusetts. You don't get a school tax and then a general government tax. It's all one.
because
It's always
really,
been that way.
the town, we don't have a school system in Rehoboth. The regional school system is sort of a vendor to us. They provide us educational services in the form of a regional school district, which we are a member of, and they give us an assessment. And then we fund that assessment at town meeting with property taxes. So, unlike some other communities like Selectman Vadney said, in some other states, they actually have a much larger regional school system, and sometimes you get a tax bill for that school system in addition to, in some instances, you get a county tax bill, and you get a city tax bill. It depends. Everyone is different.
I'm sorry, but what I remember is one tax bill and the amounts of the tax rate was divided. It was only one tax bill, but they just told you what went to the general fund and went.
Yeah, I don't remember that, but I've heard.
Just had one.
Yeah, just,
According to Skip, it's always been that.
yeah, okay. Okay, any other questions that we have from anyone else? Yes, sir.
Could you say that this is, in some sense, a recapitulation of problems that first became identifiable in 2015?
I'm not
May-
going to comment on that. It's outside the scope of the person. If you'd like to have that conversation, I'm happy to do it outside of this forum.
Okay, and secondly, are there numbers on the website or anything that would allow the ordinary citizen like me to see the cost of the school system as a percentage of and its assessments as a percentage of the town budget over, say, 10 years?
If you go back in time, if you go to the town clerk's website, there are copies of the warrants. I'm not sure how far back the town clerk has them. But if you go look at the town clerk's webpage on the website, you will see a selection that says town meeting warrants. If you look at the annual town meeting warrants, going back in time, they have going back years. So I think you can probably go back to about 2012 timeframe. If you take the oldest warrant and look at the lines for the school department and for the town, you can probably get back to about 2012.
There's no summary graph.
Skip just suggested the annual report would have that back since.
Okay.
And the town clerk's office has those from all the way back to 1900.
Yeah, but there's no summary graph over.
So you're gonna read it and you're gonna do your math. But
Yeah.
the information, the raw information is there, and it's easily accessible.
Because you might imagine what's going around mouth to mouth is not favorable on this topic. I would just like to see what the cost of the school system is over time.
And you can get that through a variety of sources.
Yeah, thank you.
You're welcome. Any other questions from anyone else? Yes, ma'am.
I just, when you mentioned the exemptions, like you said, blind, 70 plus, veterans, and surviving spouse, but we don't have a surviving spouse, what do you think? Is that one that's not in our town? Because you said some of them are various towns have various ones.
There are different sections of Mass General Law that have been adopted. I'm trying to remember which one is in Rehoboth. I think it's 40C we have in Rehoboth. We don't have the others. know that big blind is a state one, over 70, I believe is one, but the income requirements. Best thing to do is contact the assessor and ask them. They're the assessors are the subject matter experts on that topic. Anybody else? Yes, ma'am.
Warrants go back to 2014. Annual town reports go back to 2008.
Okay, so you would be able to get information go back to 2008 on the town clerk's website.
Thank you.
You're welcome. Thank you, Madam Town Clerk. Anybody else? All right, seeing nothing. Thank you very much to the selectmen for giving me the presentation or the opportunity to make the presentation. Hopefully found it informative. If anybody has any questions, email me, contact me via phone. I'm happy to spend as much time with you as necessary to answer any questions you have. Have a nice night, people.
Thank you.